Hello, everybody. Welcome back to Co-opting AI. I'm so delighted that you are all here today. I'm Monash Sloane. I'm a social scientist who studies artificial intelligence. I'm currently a professor of media studies and data science at the University of Virginia. And I am very excited to talk with my guests and you today about a topic that may give some of you cold shivers, and some will feel rage, and others feel a profound sense of security. And our topic today is insurance. Now, I think one of the things that we sometimes forget among all the talk about AI, and especially agentic AI, is that any and all AI shares the genealogy with quite traditional or historical forms of risk assessment, or even the idea of risk. And risk, of course, has everything to do with what we loosely call uncertainty, or the fact that despite our very best efforts, we cannot predict the future. Now, quantifying risk and mitigating for it is and always has been the core business of insurance. When I dug into this a little bit more in preparation for today's conversation, I was admittedly surprised to learn that the idea of insurance emerged in medieval societies, where uncertainty was pooled and managed, which birthed the idea that risk is a thing that actually is measurable and that therefore can be shared and also priced. Later, insurance needs and the ever-present desire of humans to gamble gave rise to probability theory, which of course remains the foundational logic upon which modern AI systems operate. There also is a particular framework of history in there that is the basis of AI, namely the idea that the past always predicts the future. I think that talking about insurance to understand AI and its social role is not only pressing for these historical and epistemological reasons, but the insurance industry today is also at the forefront of AI and applying AI to people because it relies on automated classification, for example, in the context of fraud detection, but also in the context of assessment of individualized risk to determine premiums, for example. So I think what is happening here that the insurance industry gives us a really good idea of what we think about risk and uncertainty and machine learning and how it interfaces with people. It's very hard to actually get into the engine rooms of both tech companies and insurance companies. We don't know how this intersection actually materializes. But that doesn't mean that we cannot or should not ask hard questions about the entanglement of AI, the individualization of risk, and the insurance industry writ large. And I am genuinely honored and very happy to be joined today by two leading experts on the topic. They are uniquely positioned to help us ask these hard questions. Joining me today are Laurence and Jathan Sadowski, and I may add that we are again spanning the globe. Jathan is in Australia and Laurence is in Europe. Starting us off today will be Jathan Sadowski, who currently is a senior lecturer and ARC Future Fellow in the Department of Human-Centered Computing at Monash University in Melbourne, Australia. He studies the political economy of information technology and risk governance with a focus on the insurance industry. He has written two books. Those books are terrific. You should go get them. The latest one is called The Mechanic and the Luddite, out with UC Press. And the other one is called Too Smart, out with MIT Press in 2020. He also has a podcast, and that podcast is a weekly podcast on technology and political economy, and it's called This Machine Kills. Following Jathan will be Laurence, who holds a PhD in political science and is also a certified actuary who combines research with professional actuarial work. She currently co-leads a research program in France examining the mutual impact of climate change and insurance mechanisms. Her interests include neoliberalism, Foucauldian studies, the intertwining of specific rationalities with modern power, and the digital turn. More recently, she has focused on the government of disasters. Her articles have been published in many places, among them the Journal of Business Ethics, Theory, Culture and Society, the Journal of Cultural Economy, and the British Journal of Sociology. Her book came out in 2020 as well. It is called Foucault and Postmodern Conceptions of Reasons. And I am so grateful that these two wonderful people are here with me today. Just a short note on housekeeping. We will hear from our two panelists. In the meantime, dear audience members, please put your questions into the green Q&A box at the bottom right of your screen, and I will fold these questions into the conversation as we go along. And with that, I'm going to shut up and pass the baton to Jathan. Thank you so much, Jathan, for being here, and thank you, Laurence.
Of course, my pleasure. Thanks for the invite, Mona. I'm very excited to do this. Very excited to be in conversation with you and Laurence. And so I'm going to kick things off. I have a prepared talk about 10, 11 minutes or so. And with this, I know the topic of the day is AI, but my talk is going to give us a little bit of a theoretical foundation for, I think, thinking about some of the really important ways that AI is playing into existing logics, perhaps exacerbating existing kind of crisis conditions, right? And so I'll give us a little theoretical base, and then we can dig deeper into AI during the discussion. And so I'll kick things off then. So with this brief talk, then my aim is to provoke some critical questions. I think that's about all you can do in 10 minutes, right? Provoke some questions in our minds about relations of risk and value, power and knowledge, creation and destruction. I'll be speaking primarily in reference to crises of climate risk governance, but this little foray into crisis theory also speaks more broadly to the way crises and their conditions and the kind of socio-technical systems that are part of those conditions draw together different relations into a tangled web. And of course, this specific talk builds on some work I've been doing with my collaborator and friend, Marion Fourcade, who's in the sociology department at UC Berkeley. So a big shout out to Marion and all of her work. So, global insurance markets are in turmoil. Climate catastrophes continue to cause record levels of destruction with entire communities lost and exclusion with entire communities abandoned. On one hand, reporting at places like the Financial Times warns us that the next financial crisis could be catalyzed by a doom loop in the insurance and reinsurance industry, leading to a collapse in mortgage markets, which causes the real estate sector to nosedive until the whole bottom falls out of the economy. On the other hand, major insurers are also enjoying what the Financial Times calls a, quote, boom in profits, thanks to, quote, highly attractive market conditions, which justify higher premiums, tighter policies, greater exclusions, and new ways to define risk. And of course, we must note that the reinsurers are also enjoying the boom times as well. So how do we make sense of this, doom on one in the Financial Times, but also boom in the Financial Times, right? For me, I always look to Lee Johnson's invaluable work on what she calls the catastrophic fix. And this work is crucial for making sense of why these loops of doom and boom exist in the insurance and reinsurance industry in the first place. So the hard market conditions, as they're called, created by catastrophic destruction, help solve the problems of capital accumulation while justifying new cycles of investment, extraction, and exclusion through what Lee calls, quote, revision of catastrophe models and re-estimation of exposed values. So what happens when you have all of this capital accumulated? Well, you have to find a way to clear the decks, right, to make room for rebirth. And indeed, for insurers, a key technology for navigating these doom and boom contradictions is their ongoing development of proprietary catastrophe risk models that are now built on machine learning that can generate actionable and profitable insights about the stochastic hazards of complex Earth systems, financial markets, and social patterns. The figure on the screen here, the image on the screen here is taken from a dashboard created by ClimateSense, which is a catastrophe modeling startup in Australia that sells this risk modeling to the city of Melbourne for planning purposes, right? And purports to give incredibly detailed demographic-based risk scores for properties and neighborhoods based on flooding, building on, of course, a proprietary data set and machine learning model. So these technologies are designed to derive value from risk, and they're framed as critical to the future of the insurance industry and the future of insurability more generally, while also framed as crucial for creating knowledge about climate risk that directs institutional and political responses to climate governance. Risk models are forms of technoscientific spatial knowledge that also produce and are produced by forms of political economic power. They are ways of modeling, envisioning, and acting, or not, upon possible planetary futures in a time of ongoing catastrophes, and ways of constructing and framing our understanding of crisis. And I think that last bit is really important. These technologies of risk are also embedded deeply within these logics of doom and boom and the dual tendencies of capital to self immolate and to destroy others, or to put simply, as Marianne and I do, the death drive of capitalism. This self destructive tendency comes clearly into view when we consider the broad implications of recent developments in actuarial methods. Data abundance and new statistical paradigms, including machine learning, have allowed the calculation of risk to expand in two directions: expansion and intensification. Expansion refers to the ever more totalizing ambitions of risk prediction methods, as their domain broadens to encompass previously uncharted objects of risk. No longer confined to assessing the likelihood of accidental injury or loan default, actuarial forms of risk analysis now pervade finance, security, fraud detection, climate science, military applications, immigration enforcement, and the list just goes on and on. One of my favorite tidbits here that most people are unaware of is that a company in the news right now, Palantir, it's all over the place. Most people know somewhat what Palantir does with with the military industrial complex, with Project Maven and the Pentagon, with ICE, right? Most people are unaware, however, that Palantir started as a fraud detection algorithm for PayPal and then was spun off into what it is now. So right there, we can see a direct line between kind of actuarial methods for detecting fraud and risk, and tying that directly now to target generation in Iran. Intensification, by contrast, is about risk prediction systems making ever more precise and personalized judgments, or at least their users making such predictive claims and then acting on them, whether accurate or otherwise. The power of these methods is constantly being enhanced and refined, often by narrowing down their object of intervention to specific places, individuals, and events. Both developments, intensification and expansion, like the industries pushing them forward, are oriented toward the end goal of total risk elimination. This ambition is unreachable, of course, since risk is rooted in dynamic uncertainty, always changing as a product of a complex social and physical world. It can never be truly eliminated in any real way. But many industries will continue to act as if total control were possible, developing increasingly sophisticated methods for identifying and controlling risk in pursuit of marginal and sometimes absurd gains. In his 2009 book, World at Risk, Ulrich Beck argued that the proliferation of catastrophic losses and the inability to govern these crises of risk marks a shift from a world of controllable and predictable risk to one of unimaginable uncertainty or unmanageable uncertainty. Beck writes, quote, The absence of adequate private insurance protection is the institutional indicator of the transition to the uncontrollable risk society of the second modernity, end quote. And to stave off this market collapse and improve the legibility of risk, the insurance industry has placed its hopes in granular data, predictive models, and precision pricing. The results have been paradoxical. Rather than taming uncertainty, this strategy has, as Beck predicted, proliferated new categories of measurable and unmeasurable risk, while also giving rise to, quote, a simultaneous collapse and expansion of private insurance coverage, end quote. And so, with this volatile, contradictory response compounding the very crisis it is meant to resolve. The expansion and intensification of risk assessment works against insurance from two directions. It destroys the willingness of insurers to insure certain types of risk, thus sending shockwaves across the industries and communities that rely on insurers to underwrite their activities. And it dissolves the risk sharing pools that made insurance viable as a business in the first place. As crisis conditions worsen, insurers become ever more risk averse, which pushes them to ratchet up their quest for identifying, pricing, and excluding bad risk. The end goal is to eliminate any heterogeneity in risk pools by multiplying the number of factors that can be used to profile, rank, and compare individuals or locations or events, while also increasing the threshold of what counts as a good risk as a backstop against any variables that might lead to a loss. However, insurance only works because there is a lot of uncertainty about when, where, how, and whom disaster will strike. With a large and diverse enough risk pool, you can use statistical analysis to discern broad patterns that let you profitably hedge against this uncertainty. It is this stochastic nature of risk that makes insurance into a financially stable industry and a socially useful institution. But if insurers can predict and price risk at precise enough levels, or even if they just use sophisticated socio-technical performances of power and knowledge to make people believe that they have these capabilities of precision and thus act accordingly, then, as the industry itself recognizes, insurance would become unaffordable and inaccessible to people who would really need to pool their risk, while people who are low risk won't need to buy insurance, and those who are wealthy will be relatively insulated from truly adverse effects of premium increases. Moved by its own institutional logic and technical capacity, the insurance industry seems unable to stop itself from pushing harder and faster in this direction, despite recognizing the self harm and collateral damage that comes from decoupling the social purpose of insurance from the financial practice of risk governance. In industry statements, media narratives, and government policies, insurers are regularly framed as victims of external shocks from climate catastrophes and unpredictable impacts to their systems of risk management. The crisis is framed as physical, stemming from extreme weather events. The crisis is framed as mathematical, stemming from insufficiently accurate models of hazard and exposure. But of course, even more fundamentally, the crisis is always socially constructed. The crisis is financial, stemming from the technical systems designed to render risk into a valuable asset on balance sheets and investment portfolios. The crisis is political, stemming, as Stephen Collier writes, from, quote, the rapid and often chaotic oscillation between mutualism and individualism in disaster insurance and policy, end quote. The crisis is capital, stemming from its Shiva complex, or a need to be both destroyer and creator of the world. This is where the creative destruction of capital meets the destructive creation of crisis. In other words, capitalism as a system depends on recurrent waves of liquidation to eliminate existing stocks of capital and stoke new cycles of investment and innovation. But at the same time, capitalism cannot help but create the conditions for crisis and exacerbate the destruction of crises, undermining the solid ground that everybody, capital included, depends upon, even if it means being brought to the brink of death time and time again. All this despite that insurance, the industry in the eye of this storm, only exists to make the world a more stable, less risky place to do business. This is how the seemingly exogenous shocks of natural disasters serve as cover for the decidedly social causes of catastrophe and the pathological death drive of capital. So, my final provocation is this: the effective governance of crisis and its consequences will always fail if it is only ever reacting to an endless series of catastrophes, rather than premised on controlling the destructive creation of crises and their conditions by capital. Thank you.
Thank you very much, Jathan. Laurence, I think there are so many connecting points for you.
Yeah,
So
I
I'm
think we are going
handing
to have
over to you.
a great discussion afterwards. Well, thank you, Mona, for this invitation to talk about AI and insurance. I must apologize for my French accent, and if sometimes I'm not clear, please stop me and tell me to repeat or pronounce differently. I don't know. So what I would like to do here is to explore how the way we perceive individuals and populations changed over time with probability and statistics, because usually we hear that thanks to AI, we have moved from using probability to understand groups to using it to evaluate and predict individuals. Therefore, we would have now individualized risk, so-called individualized risk. I would like here to challenge this view. I think there is indeed a transformation going on, but it started a long time ago, long before the advent of AI, and therefore it has not much to do with it. And I will really go on a historical path in order to show what I'm talking about. Ian Hacking said that the 19th century saw an avalanche of printed numbers. Adolphe Quetelet, a Belgian statistician, is a good example of what could be done with these numbers. Looking at the size of the torso of Belgian soldiers, he realized that they were distributed along a bell curve. Now, Gauss had mathematically formalized this curve, also known as the curve of errors, some 50 years earlier, when measuring the position of the stars. His measures were distributed along a bell curve, and he proved that the true position of the star is where he had a peak of observations. And because errors in measurements cancel each other out, the true position of the star is also the average of his measurements. By analogy, Quetelet concluded that if the soldiers' torso were normally distributed, this meant they were all experimental measurements of some true theoretical man, he called the average man, who represents this population. The deviation from the mean was noise that should be discarded in order to focus on the regularity displayed by the collective. This is basically how insurance started to expand. While individual events such as accidents and illnesses are unpredictable, they become statistically manageable when considered across large populations. Insurance schemes such as workers' compensation that took shape across industrial societies at the end of the 19th century are based on the motto that we do not know what will happen to you, but we know what will happen to a group of people like you. Uncertainty is transformed into calculable risk at the group level when you adopt the statistical gaze, one that embraces the veil of ignorance concerning individuals. François Evans has shown that these insurance mechanisms also enacted a solidarity between members of the group who could collectively cope with uncertain events. In this framework, probability serves a social function. It allows societies to manage uncertainty and to build institutions that protect individuals through collective arrangements. The misfortunes of a few can be covered by the contributions of the many. However, this vision of statistics centered on averages and collectives was challenged by another major figure of the 19th century, Francis Galton. Galton shifted the focus away from the average and toward individual differences. He was interested not in the average, but in the variation around the average. For him, the stability of the bell curve observed across many human phenomena meant that nature had distributed individuals between above average men and below average men. And if we could have only the above average reproduce between themselves, then we could improve the population as a whole. Galton was the infamous father of eugenics, a theory which did not survive. But his intuition that a number which he called genetic value could be attributed to individuals did survive, although at the time it was a view of the mind. Interestingly, during the 20th century, both views worked concomitantly in insurance pricing through classification. On the one hand, since you didn't have many variables, you created classes. People with the same characteristics form a class and are assumed to be identical. The average of the class was the price for the class. On the other hand, in order to meet competition and face adverse selection, segmentation was getting more and more granular. This also means that actually we're busy explaining more of the variance within the class. So it's more like the Galtonian view. But the focus remained on the class, mainly because you need to have enough people in the class in order to have a stable model, in order to have the law of large numbers work, basically. And this basically remains true until the end of the 20th century. At this point, we can identify what is truly new in today's context. So the first point is big data. Unlike in the past, when data had to be manually collected with questionnaires and converted into numerical form, much of today's information is natively digital. Our activities, online interactions, movements, transactions are automatically recorded as data. You do not need to quantify things anymore. This fundamentally changes the scale and nature of what is available for pricing because we suddenly have access to behavior and to tracking it in real time. The focus shifts from static characteristics, the questionnaires, to dynamic behavior. And you have two main examples of possible use of big data in insurance, which are motor insurance, where sensors in the car now collect data on position, speed, and acceleration every second, and in health or life insurance, where you now have wearables or smart watches to monitor for heart rate, quality of sleep, etc., etc. The second change is AI. And here I use AI as a synonym for sophisticated algorithms such as neural networks, random forests. I'm not really talking about LLMs, that is now the hype. So when you were working with regressions, you were interested in the relation between variables. You had the kind of view à la Quetelet in which the individual is only a point in order to understand the collective behavior. But the new algorithms are different. They use these so many data points available for each individual to calculate a score for this individual. You do not try to understand global trends, but to attribute a number to each person. You do not adopt a statistical gaze which accepted the veil of ignorance as a condition to build collective knowledge. Today, the collective is built bottom up from a supposed knowledge on each individual. In a way, Galton's view is now dominant. The main difference between Galton's genetic value and current scores is that his vision was deterministic, whereas scores are probabilistic, even if they actively shape today opportunities and constraints in the lives of people. And you have this kind of scores being used in credit scoring in the US, not in Europe, and in recommendation algorithms. And what about insurance? Well, in insurance, I think the picture is much more nuanced than a true individualization of risk. The first point is because conceptually, insurance remains a game of mutualization. It cannot be otherwise. Even in highly granular systems, insurance still relies on pooling risks. And if you think about it, if you could really predict who is going to have an accident and who is not, then you wouldn't have insurance at all. Because those who have accidents would have to pay the cost of damage, the cost of their damage, which is absurd. And those who don't have accidents wouldn't need insurance at all. So the insurers do not have any intention to go that far. So what is being done with the behavioral data and dynamic data that I just talked about is that new classes are created. You use them to introduce new segmentation, but it's more the continuation of the same rather than a change of paradigm. So what then has truly changed? I think the answer lies not in technology or in data, but in perception. There has been a profound shift in how groups and individuals are understood, and as a result, in the perception of what is fair. Today, the common understanding of fairness is not that all should contribute to the misfortune of the few, but that each should pay for his risk. Even before AI, what you try to do is segment as much as possible. Today, big data provides new possible segmentation to the already existing spiral, and the AI hype makes people believe that striving for the individual risk is technically the correct view. We would have reached the asymptotic paradise of statistics where each individual would be a segment of his own. As a result, it's far more difficult today to build insurance schemes that insist on solidarity, even if, as I said, it is the core of insurance. I have been working recently on natural catastrophe insurance, and most of the schemes that exist were put in place during the 20th century on the motto that we do not know where or when this disaster will happen, but together we can build solidaristic solutions. This is the case in France, in Spain, or in Switzerland, to name a few. But when you speak to insurance professionals that have known these solidaristic schemes for a long time, they all tell you that you could not create such a scheme today. People would not accept the idea of sharing. New data and new models make it possible to know quite precisely the risk of a given area, which was not the case 50 years ago. And Jathan just showed us on his maps what is being possible today. What this granularity does, specifically for natural disaster, is that it quickly becomes unaffordable for most people. So even if insurance is still about solidarity, the way you can practice insurance is changing, not because of AI, but because of the changing conception of what insurance fairness is all about. Thank you.
Thank you so much, Laurence. This was extremely interesting to hear from you both. I'm going to get started with some questions. Dear audience members, please start putting your questions into the Q&A box. I think there's a lot to discuss and a lot to ask as well. So, Jathan, I'm going to start with you, and I think, Laurence, this is for you as well. Jathan, you speak about the doom and boom, right? The sort of binary that is a productive force in insurance. And that really reminds me of actually the AI industry, right? We speak about doomers and boomers, about AI enthusiasts, and about those who think of a future with AI that is going to eradicate humanity. And people sort of switch between the two as well, sometimes depending on what is opportune for them in the moment, prominent figures. Can you speak a little bit more, or maybe, think on the spot about that relationship, or this perhaps significance of this doom boom binary as sort of a productive force that cuts across both of these industries?
Yeah, for sure. And I think it's a really important pickup. And to me, the thing that kind of links those together, right, is like, these cycles of crisis. I mean, I think to be really clear, like, I talk about, crisis as my talk was a kind of foray into crisis theory, but this is not like a category I'm exporting onto the insurance industry or onto this topic, right? Like this is a category, used by the actors I'm speaking about, because crisis is very productive, right? Like to frame, I'm thinking here about like Janet Reuteman's work as well, and like anti-crisis, right? That like crisis is very productive. It's a way of coordinating a bunch of people around an event or around a situation. It's a way of adding urgency. It's a way of directing resources, capital, time, energy into a thing, right? And so I think that this, we see this in AI, right, where there's a crisis, and it was very useful to talk about existential risk and all that kind of stuff in the AI industry until it stopped being productive enough, right? The marginal benefits of talking about, a civilization ending AI, we're getting smaller and smaller. And so if you notice, everyone has just kind of stopped talking about that, right? Like Sam Altman, you maybe have a couple like, Eliza Yudkowsky or someone who is like his whole brand is built on this, right? So it's like, gotta hold on to it. But I think what's really interesting is that like the framing of a crisis is just as, if not more important than the substance of the crisis, right? How are we framing it, and what are what then become the necessary interventions or solutions or transformations that have to happen to confront that crisis? And in the insurance industry, I think it's not to say there's no catastrophes or disasters or problems, right? But that the question here is, how is the crisis framed and what are the solutions to that crisis? And in the insurance industry, I think it's really common that we see the crisis here is one of uninsurability. What does that mean? It means the industry has deemed some risk is no longer profitably insurable by the industry as it currently exists. And usually what that means is, well, now some external force, the state, has to come in and make that risk insurable again. And we see this happening, in California with the wildfires and Allstate and State Farm, exiting the market. But like this is happening cyclically, constantly, where the world is uninsurable until it's made insurable again. And so for me, the interesting bit is what's the politics, the technology, like what has to happen to make the world insurable, and what transformations and to whose benefit how is the world intervened upon to be made insurable, to overcome crisis until the next one.
Thank you for that, Laurence. So
Can I react?
yes, I was going to ask you to do that and then tag
Okay,
question
good.
on. You
Okay,
go.
good. I completely agree that this idea of crisis is fundamental in when we speak about climate change. And I think what is interesting is the way it has been mobilized first by reinsurance companies, not insurers themselves, but reinsurance companies that posited themselves as the experts who could provide new models in order to explain to everybody what's going to happen with climate change. And of course, there is a paradox here because many people already explained that what in a way they see in this an opportunity for more business, of course, and this is how they are going to promote the next wave of models that they are going to make business on. I think that what is currently happening between insurers and reinsurers is quite interesting because there is a kind of negotiation of who is going to take, because, okay, the risks are increasing. They're really increasing. I mean, there is really a crisis in that, meaning that climate change is true and happening. But the split between what the insurers are going to take and the reinsurers are going to take in this game is changing, and they are discussing between themselves. And this is where Jathan is correct that when the reinsurers decided that they won't want to take a risk and the insurers themselves say, well, I cannot either, they both turn to the state. And my point I would have 2 points about that. I think that when you look at catastrophe insurance, you cannot think about it in the way you look at other insurance products, where you can look at it as a bilateral relation between an insurer and an insured person. It's always including a lot of other stakeholders, such as the insurers, such as the states, such as the community, because prevention most of the time needs to be done at a local level, but not at the individual level. And this is where it's starting to be really interesting when you speak about AI, because you could use AI, as we just described, in order to increase the premium to a point where people cannot afford insurance. But you can also use the kind of knowledge that we talked about, the kind of maps that Jathan just showed, in order to target prevention to very specific areas. And then you could reap a lot of benefit from that, because instead of having very large prevention projects that are not really efficient, then you could use AI in a very in a good manner without having it reflected in premium. And I think that would be the good view about AI in catastrophe insurance.
Thank you for that. I'm gonna stay with that for a moment. Laurence, you said something quite profound. You said Galton is now the dominant view, and of
Yeah.
course, Galton is, one of the founding fathers of statistics, and with my data science students, we talk about where do statistics come from, what are the epistemological roots of what we now call data-centric systems or AI prediction. And you sort of, I think, tied this to the idea that everything is now individualized and more granular, and that is essentially the end game of the use of AI in risk prediction or the management of uncertainty, is this granularity, this individualization. And that's where the Dalton resides. Is that a fair representation? Would you say that that is what's happening? We're living with Galton now, because obviously insurance is everywhere and AI is everywhere as well, right? So I'm wondering about the sort of the bigger epistemic
Yeah.
consequence
Yeah, I think it's a question of the social construct. I think that Galton is everywhere because this is the way we want to use statistics today. And when I say we, I do not necessarily mean insurance companies, because I do believe that in insurance companies, you cannot really use very individuals indicators. Individualized, it won't work. So usually you would take this, for instance, credit scoring, and which is very, very open, and you would split the data into three, between the green, the yellow, and the red, and you will use this instead of the continuous score that you would have. So I don't think in insurance it's really what's happening, but I do believe that in society today, we do believe that we all stand and as different, and that we have. I mean, if you speak today to people and say, what is your risk, they do believe they have a risk of their own, where it doesn't make any sense. But everybody has, we have been, I mean, this social construct of individualization, of scoring, etc., is very strong at every level. It's kind of a new paradigm, and it's very difficult to resist that. That's what I think.
So in a way, the social logic has shifted the way which
Yeah,
we relate to
completely.
one.
Yeah.
Jathan, I'm gonna take that as a cue to ask you a question that I hope also resonates with the audience. And by the way, audience members, please put more questions into the Q&A box. You spoke about good risk and the construction of good risk. Can you,
Mm.
from your field work, and I know for a fact you've done tons of field work and have a lot of insight into how the insurance industry actually works, can you tell us what is meant by good risk?
Yeah, and it's true. I spend a lot of time at largely insurance and actuarial industry conferences, talking to people in the kind of B2B conditions where the market is really made. But I think the concept of good risk and bad risk is really important because it really wraps in how much insurance is a moral economy, right? It's a moral economy of desert, right? What do people deserve, right? It's a moral economy of loss, as like Rebecca Elliott's work, a great sociologist who's spent a lot of time really thinking about what should be lost, who deserves to lose what and be made whole again, right? And it's this moral economy of fairness, what Laurence was talking about, right? Like the underlying, the insurance industry is a very idiosyncratic conception of fairness, of actuarial fairness. I think a lot of people, and I think the insurance industry is very happy for people to conflate these different ideas of fairness. That when insurers say no, this is fair, most people have a more of a justice oriented or moral oriented idea of what fairness is. But the insurers have a statistical idea of what fairness is, an actuarial one. It's that what's fair is that everyone pays exactly of what their risk is, right? No more and no less. So when you bring risk into a shared pool, you should pay according to how much risk you're bringing into that pool. If you're overpaying, then that's not fair because you're paying more than than the risk you're bringing in. If you're underpaying, well, that's actually way worse, right? Because now you're being subsidized by all these other people, and now you're going to be subject to what's called moral hazard, right? You're going to act, according to economics, right? This idea that if you don't have to pay for the full price of your actions, then you're going to take more risky actions. There's the adverse selection, as the insurance industry calls, which I think for them is even worse than moral hazard, right? Which is this idea that the policyholder has more information about their risk than the insurers do, which they see. Well, that's not fair. You know all this information about your individual risk, and you're not sharing it with us. So how can we properly, underwrite your policy and charge you in the correct way or constrain your conditions in the correct way? And so I think, this kind of this actuarial conception of fairness, which is about trying to say, everyone should, in order for this to work as a social institution, we can't have any freeloaders. But I think they use that as justification. And when I talk to insurers, reinsurers, actuaries, they'll talk about this quite explicitly. They use that as justification for this kind of arms race of, what now I've called in my work and others have called a kind of inverse selection, right? Where the insurers now know more about you than you do about yourself, because this arms race of trying to combat adverse selection or combating against moral hazard by, we focus a lot of time on underwriting, and that's where a lot of interesting stuff happens. But I think actually a lot more impactful technologies are happening after the underwriting stage, right? After you decide what you're going to charge someone, how you're going to construct an insurance policy. It happens at the stage of policy management. How are you interacting with, how's the insurance interacting with the policyholder, through these kind of dynamic interactions, or what Laurence was talking about in terms of like constant collection of behavioral data, right? But it also happens at the stage of like claims management and fraud investigation, right? Where I think some of the actually most invasive and aggressive forms of technological practices happen at the stage of fraud investigation and claims management. And again, that really goes to this fairness, right? We're at, if actuarial fairness is the priority above all, and with that is safeguarding the insurance company's profits and financial sustainability and growth, then we're going to treat fraud and claims as these places where your whole life needs to be on display, right? And I've talked to a number of insurtech startups that sell these devices where it's kind of like think about it like the insurers used to rely on the Pinkertons, right? The the famous detective agency and strike busters to go and literally investigate people's lives, and now I've talked to startups that have what they call a kind of a digital Pinkerton, right? Where it's like this idea we're going to be scraping the web for every single thing about Mona Sloane that we can find. Not just any social media posts that you've put up, but anything that tags you or any pictures of you. And we can do that with, facial recognition, right? And we're going to create this massive dossier of your life and then comb through it with a fine-tooth comb to see, are you actually telling the truth about your accident? Or are you actually telling the truth about this part of your life that you're trying to make a claim on? And again, all of this is done with the moral justification of actuarial fairness. So I think that aspect is really crucial to the industry, but also as a way to justify this kind of technological arms race that we're talking about around personalization, investigation. But I think something Laurence really brought up that I think is really profound as well is personalization framed as a kind of anti-solidarity. Because I agree, I don't think it's actually individualization or personalization in the way that the industry wants or claims or pushes towards. I think the most productive aspect of these technologies is the kind of anti-solidarity, what Durkheim calls the anomie, right? This kind of dissolution of social bonds that connect individuals and communities together. That's really what these technologies are. They're kind of an acid on the social bonds that connect us together.
It seems we can't think about AI and insurance and risk without thinking about fairness in all the ways, right? Across the spectrum. I'm going to ask one more question, and we have a ton of really great questions from the audience. Audience members, keep them coming. Can you both, from your research and professional experience, explain to us where insurance companies get their data from? Jathan, you alluded to this a little bit, but you also showed the ClimaSense map. What are the data points? Where does insurance data come from today? Laurence, you mentioned vehicles, for example. What are all the points where humans produce data about humans that is used for insurance, and what are all the sort of non-human touch points that produce data that is used for insurance, just so that we get a bit of an understanding of the landscape of the data that feeds into the intersection of AI and insurance.
Well, it depends on what kind of insurance product you talk about. So for instance, when you talk about motor insurance, then you have these sensors which allows you to create usage-based insurance, which is you collect data from the car. You have sensors in the car that collect data on acceleration. You can infer from this a lot of things. You can also couple this with other data that would be more contextual, like the kind of traffic you had on the road, or what was the weather, which was bad weather, good weather, in order to enrich this kind of information. But it wouldn't be done within the insurance company. They would usually use an outside vendor who would collect the data and provide it already in a bit elaborated by the vendor, because the technologies that are used in insurance companies are old technologies. They do not really fit this big data, and that could be, it's huge amount of data that you collected when you do that at the second or millisecond even sometimes. You have also, but when we speak about, for instance, climate change and the kind of models that you can build now in order to integrate climate change, you could even be using IPCC data that a group of regulators have organized themselves. It's called the NGFS, in order to provide scenarios for the future climate, in order to integrate that into the models. So you are not working anymore on statistical data that has been collected in the past, but you also try to do what ifs. So you're building scenarios in order to understand, well, if the climate is going to go up to 4.5 or CP, what will happen, etc., etc. So you have today the possibilities are almost infinite, because you can all the time you can use more data coming from different organizations in order to enrich what you can do.
Thank you, Laurence. Jathan, do you have information to add?
Yeah, I mean, I think that this real difference between kind of actuarial science and data science as well. And I think so if we think of actuarial science as the tool of the trade there, right, is the generalized linear model, right? There's kind of just a linear regression.
Exactly.
You've got four or five variables that you're feeding in, and you're just really drawing a straight line through some data and saying there it is, right? And it's all very explainable. It's very doable if you know some linear algebra, right? And this is the tool of the trade of the actuarial profession. And a lot of, depending on the coverage area and the jurisdiction, insurers can have real restrictions on what kind
Mhm.
of data they can provide, or use, what kind of categories and classes, and how they can and can't use, right? And so, but what Laurence is saying is exactly right, where it's like the data science, and some of the insurers are having this in-house, but they rely a lot on these outside vendors as well, where the data science is more about machine learning, right? It's like, just throwing a bunch of data into models that are inexplainable. You have no idea what the relationships are between variables and outcomes. And there you get this real like desire for more and more data that you can just throw into a model. And so this is where you start seeing, the Climate and Community Institute and Consumer Federation of America just recently put out a report talking about the effects of credit scoring on insurance in the US, and that actually a person's credit score can have more of an impact on their home insurance premium than the physical risk of where they live, right? So you can live in a place that's acceptable to wildfires or flooding and everything, but if your credit score is high, then it'll offset it. But if your credit score is on the lower bracket, that can make your premium go up, up to 2 times more, right? And so that is the result of someone deciding somewhere, hey, we should test a correlation between payouts and claims and credit scores, and then they find a profitable correlation. And so I think there's this, just like with a lot of machine learning, you see this like this seeking for profitable correlations that can be translated into some kind of score that can then, whether for underwriting, there's a lot of restrictions around underwriting, but a lot of these scores are sold as like marketing scores or claims scores or insurance scores, right? They're sold as things that are not meant to be used for underwriting, regulator, they're used for other parts of the business, but they functionally have the same impact.
I think it's very interesting because the, the scores are a probabilistic number that is attributed to an individual. And sometimes it has nothing to do with the true history of risk of that individual. And then it creates a situation that you could have your premium go up from one year to the next. And you do not understand because nothing happened. You didn't have a claim or anything. And it's a problem even for insurers because at some point, you need to explain what you're doing. And when you use this kind of numbers and the probability is high, but you do not really know why because it's a black box number. It's very complicated. And I spoke to Italian insurers that used a lot of UBI models in the past, and for pricing. And they are coming back from that because of that, because they had many clients that were really unhappy with the results and leaving them at the end of the day.
Mhm. I'm going to start bringing in our wonderful audience and their questions, and so we're going to stay with the premium conversation. Robert Alish is asking, will AI on autonomous automobiles and trucks make their insurance less expensive, which I think is sort of a note on the human and the human individualized risk. And I think questions about if we remove the human, is there going to be a change in how we calculate risk and insurance premiums in automotive? Laurence, what do you think?
Well, at the end of the day, the insurers needs a certain amount of premium in order to cover the risk overall. So either you go with an average, which would be like that, and everybody pays the same. It would work. It used to work. This was how it was. But once you introduce this kind of UBI, you're going to do it like that. You're going to try to lower the rates for some, but if you lower the rates from some, others will have to pay a lot more. This is what you have to understand. It's never going to be everybody is going to pay less. This is not going to happen because you need a certain amount in order to cover the losses on overall. And this is why we were speaking about catastrophes. If you don't create large pools with average that are based on a very large pool of people, the people that are going to pay more are going to pay a lot more to really impossible amounts because the loss is the size of their house in terms of amount. So this is where it's really getting tricky. If you push this difference too much, then you really create a problem of insurability, what Jathan was talking about at the beginning of the session.
Yeah, and I think this is really crucial too, because like you'll see this talked about by the industry or the financial press that, right, like, well, with these new technologies, hey, you might end up paying less, actually, it turns out you were less risky than we thought you were. But in practice, those are hard and those are few and far between to actually find like a meaningful discount in your premium, right? It doesn't really, as Laurence was saying, doesn't really lower the floor. It just raises it, right? And like,
No, I'm saying that it's just some will pay
well,
less, but some will pay more. That's what I'm saying.
right. Yeah, and as a whole, because the floor needs to kind of either stay where it
Exactly.
is or it needs to raise. It's never going
Exactly.
to really lower, right?
Exactly.
And I think what's really interesting here, go back to my talk around these kind of cycles of doom and boom of hard markets and soft markets, is you will regularly hear, and Lee Johnson's work is great on this. The Financial Times is really good on this. You will regularly hear people in the reinsurance industry, especially say like, man, we really need a hurricane to hit Florida. The market is too soft right now. It's too inclusive. Premiums are too low. We really need a hard market. We need a big destructive event that can kind of catalyze a tightening of the market so that premiums can go up, so that we can kind of, reach the equilibrium again that we want. And so you'll hear people in the reinsurance industry regularly say this, which is completely counterintuitive, right? But it's because a hard market for consumers is a good market for insurers, right? And so the interest between insurers and consumers when it comes to crisis, catastrophe, risk, and so on, are in some ways, really important ways, completely counterposed to each other.
We're gonna stay with that hard and soft, boom and bust for a little bit, and I have a question that I think is for both of you. Azish Filabi is saying, well, the insurance industry itself experiences these pronounced boom and bust cycles. To what extent do you see insurers as managing and shaping these cycles versus being vulnerable to them like other market participants? How can their leaders better navigate these dynamics? So, Laurence, how can insurance?
I think as Jathan said, the fact of the soft or hard market is more coming from the reinsurers than the insurers. The insurers themselves, they get some price from the reinsurer, and this is how they are going to price to the customers. It's kind of cascading but they do not really decide on that. Yeah, that's what I believe.
Mm. Yeah, and I'll just say as well, I think that like I don't buy into the very common framing that like the insurers and reinsurers are also just being buffeted by the winds of chance here, that they are also like that they are victims of exogenous shocks. As I said in my talk, like these crises are socially constructed, right? And our responses to them, our framing of them, the conditions of them are socially constructed in really important ways. And you see this in the relationship between when insurers decide that they're only in the business of risk transfer. There's a set pool of risk out there, and we're just writing contracts about how much you're going to pay me to transfer some of your risk onto my balance sheet, versus when insurers engage in practices of like risk reduction or risk management. And you see this. The insurers love, they and reinsurers have it both ways. Sometimes they'll say, "Hey, I'm only in the business of risk transfer," right? We're just writing contracts about a static external pool of risk that exists out there. But then sometimes they'll say, we really need to engage in, practices of risk reduction, risk management. And what you see is the insurers decide which business they're in according to what's most certain and profitable for them at that time, right? Are they sure that this risk reduction effort is going to reflect profitably for them? And if they're not certain about that, then they'll say, we don't know. The science is uncertain, right? We don't know if this form of home hardening will actually reduce risk in a real material way. So we're only going to do transfer. So I think again, you look at how the insurance industry behaves and how they choose to behave in different ways in different conditions. And I think you really get a sense of how much they are actively shaping the kind of conditions of risk, not just responding to them.
Right, but at the same time, as you said earlier, there are, developments, and I think you said Spain and Italy that are more pivoting towards the idea of solidarity, and also that, climate change is real. There's a real
Mhm.
markedly different environment in which markets and people and communities operate, right?
Yeah,
So,
completely. I think it's really different from one place to another. I
Hmm.
was part last week of an actuarial conference, and Jathan mentioned earlier on the idea of actuarial fairness, which is adjusting premium to risks. And in France, as far as catastrophe insurance is concerned, it's a very solidaristic frame. Today, it's really like that. It's very flat. And there was this talk, and we were trying to explain that, well, because of this new knowledge that you have at the very granular level, that might be some insurance companies that will try to introduce some segmentation, creating this situation where some people will start to pay more than others. And in the audience, there was an economist. And I think that the idea of actuarial fairness is not really an actuarial idea. It came from the economists working on insurance. It was the idea of Kenneth Arrow working on
Mm.
these issues, and he introduced that together with asymmetry of information, etc., etc. It's really an economic discourse rather than an actuarial one. So there was this economist in the audience, and she said, but why, if some of the insurers would start to introduce some segmentation, why wouldn't the others do the same? Because the economic logic would mean that, well, they should all do the same. And she couldn't understand. She was sure that, okay, so the others that do not have the means to do it, they do not have the knowledge, they do not have the technology. And you would tell, no, they do have the technology, but they want to maintain a flat price because of solidarity, because they believe in solidarity. And she couldn't get the idea. It was very funny. And at some point in the conference, someone told her, look, I work in a mutualist society. I'm the kind of insurers that's really trying to keep solidarity. We have the tools, we know where it should be higher, but we are not going to charge for that amount. So really, depending on the country, on the nation, on the culture of the place, also the way the scheme was put in place, you might have some incentives for insurers to do something or not. And in France, for instance, this was created in the 1980s, and it's still working. I don't know for how long it will still work because of all what we already said, but at the moment it's still working.
Let's stay with the notion of values playing a role here and culture. And
Mhm.
so Ashkadave is thanking you for your contributions and says we have a lot of really interesting examples about individualistic focused versions of fairness. But those mentioned are in largely Western societies. How does this track to societies or countries that are less individualistic and have just a different notion of how individual people relate to the communities around them? In other words, how can we elevate this conversation or these questions, I suppose, to a sort of more global conversation? Or what are the kinds of critical questions we should ask of themselves as we do this?
Well, I think it's a very interesting question. My problem is that I do not know enough about non-Western countries to answer. But it's a very good point. I mean, the way people perceive risk is really a cultural thing, and in what I'm sure that in different places you would have different schemes. Even if you compare France and the States, it's different. So yeah, definitely.
Yeah, and I think that's exactly right. Like there's a lot of different ways of doing this, right? There's of balancing these questions of individualism and mutualism, of market versus, marketization versus socialization, of the risk, and which one is the kind of dominant value or system in the way that you construct a program, or an initiative or something like that. There's lots of different ways of doing this, and what I think Laurence really got at in the last response as well is that like it's a choice, right? It all comes down to a choice, because you will regularly hear people in the industry, in the insurance industry, talk about this kind of like no other choice, right? This, what Marx calls the mute compulsion of the market, that like, I don't have a choice but to, engage in this arms race of individualization and categorization, right? Because if I don't do it, so then my competitor is going to do it, and then I'm out of business. I don't have a choice. And so they you kind of outsource your agency to the market, and then it becomes this like, well, new technologies just come on the market. Who knows where they come from, but they come on the market, and then I have no choice but to use them to figure out how to integrate them. But that's not true, right? Like it's always a choice. It's a choice to it's not just a choice to not create some technologies, but it's also a choice to not use some of them. And I think what Laurence was really getting at there is that like every decision, every response that I have no other choice is also a choice, right? It's a choice to engage in a certain kind of political economy of risk, but to just outsource your to legitimize it through this kind of outsourcing of your agency to the market. But that is still a choice. And I think that what Laurent said as well is really interesting, where, this sense of like that we all have this feeling that we all have our own risk score, that we're all, that we all have individual risk. And it creates this kind of like, well, I don't want to cross subsidize Mona's risk, because that's not fair to me. There's a really good empirical and theoretical question about how much that is downstream from, the how much that is that perception is downstream from the creation of technologies and institutions that are telling you we can now calculate your risk, and then that becomes a social perception, versus how much what the relationship there, right? If is there a social perception that we all have our own risk, and thus that influences the design of technologies to materialize that perception? I don't know. I think it's probably a dialectic, because that's me, of a little bit of both ways. But I think what's really interesting there is understanding how our values about technology then shape our visions of what's possible and what's not possible. And so if we all think that we have individual risk and that we all deserve to be treated as personal individuals, then that, like that, as Laurence was saying, that's anti-solidaristic. You probably aren't creating individualist technologies in any real accurate sense. But what you are doing is creating a society that behaves as if those technologies exist. And then it becomes a self-defeating prophecy.
So, what, as folks who are interested in this, right? Us, our audience members, probably the wider publics, what can we do to participate in choice making, right? There's always the big black box narrative, which I think applies to both AI, but also the insurance industry. I don't think it was ever clear to me pre-AI how my premiums were calculated. There had to be lawsuits to figure out if gender played a role and all these kinds of things. So how can, if we take these findings at face value and say, okay, this is choice, this has everything to do with value. Heightened risks are real. Insurance leaders are facing new challenges as they are also participating in the sort of boom and bust cycles. What are the next steps that we can take? What conversations should we be having? What should we be reading? What questions should we be asking? And what sort of expectations should we maybe also have of journalists, for example, or where can we find more information? Laurence, what's your tip for us?
From my view, all these catastrophe schemes are a question of common good. And I think that if we start framing it as common good, as a situation where you have multiple actors that need to be involved, it will be much easier to making clear that it's a kind of collective choice. How do we want to make society together? What kind of world do we want to live in together? What kind of community do we want to live in together? And I think that speaking about this common good makes it clearer the fact that it's not an insurance product. It's something else. We're talking about something else. Or something that we build together in common.
Yeah, and I 100% agree with that. That from the kind of the point of view of politics, right? That like we should be demanding and pushing for solidarity, for understanding disaster insurance as a common good, because the crises and catastrophes are they don't hit individuals, right? They hit communities. They and so I we should be pushing for that because it's also proven to really be the only way out, right? That like, all the research shows that, if you have adequate insurance coverage, then your ability to be more resilient to recover after a disaster is so radically better and different than if you don't, right? And that like there's a lot of flow on effects from that, and we should be demanding that. I also from the that's my my socialist politics hat, right? But if I'm going to put on my consumer advocate hat as well from a kind of individual point, I also always tell people to complain because insurance in a lot of jurisdictions is a industry that is regulated and investigated through a complaints driven mechanism. It's really hard for a lot of regulators to have the resources and ability to like proactively investigate insurers. They also just don't know where to direct their efforts with such a huge. And so most of the strides that we've seen for like anti-discrimination in insurance, for like, unfair and exploitative business practice, a lot of that is driven by complaints and like class action lawsuits, and so I think you should demand appeals and reviews of decisions, right? Insurers do a lot to make it really, really, really difficult to appeal decisions, especially health insurers in the US, but you see this more broadly, right? But and because they know that I think in health insurance only like 5% of people appeal decisions, and so they know that they can afford to give bad decisions to people because the vast majority won't go through the effort of appealing it. And so you should appeal, you should demand review, you should complain to your politician, to your state regulator in the insurance, or in the U.S. insurance is regulated at the state basis. And so you should complain because that is where actually a lot of change happens in the insurance industry, is through people complaining. But they've also created a market and an industry that completely disincentivizes, prevents, and punishes you for trying to complain and stand up for your rights. And we shouldn't allow for that to happen.
And perhaps we can use AI to help us with that. And with that, we are at time. My heartfelt and sincere thanks to Jathan Sadowski and Laurence for joining me today in a terrific and extremely enlightening conversation about AI and insurance. A big thanks to Australia and France. Thank you for joining. Thank you, wonderful audience, for your engaged questions. Apologies we couldn't get to all the questions, but you can find Jathan and Laurence online, read their books, find them online, listen to Jathan's podcast, and join us again for our last event in the spring semester, which will be on geopolitics. And we will be talking about all the geopolitical dimensions of AI, from national security aspects to global political economy concerns, ethical dimensions, and also diplomacy. We'll be hearing from Pablo Chavez, Nick Schnietek, and Chinasa Okolo, and I'm delighted to be welcoming them. But thank you so much for now. Thank you, Jathan and Laurence, and until very soon, everybody. Thank you.
Thank you.
Thanks.